So this next section is post-analysis. A lot of people hate giving this presentation. This was originally done by Steve Birch, who's the president of William O'Neill and Company right now. He's a very smart guy. He really likes technology, the Excel stuff. A lot of the other folks, Mike has done this presentation before, Scott O'Neill has done this presentation before, and they kind of get, oh man, you know, it just seems so dry and boring and stuff like that. But I think there's something kind of fun about post-analysis. I think there's something that's kind of interesting about what you learn about yourself, and also that whole process of figuring out how I could have done this better. Post-analysis is really what created CanSlim. If you think about when Bill first started, all the mistakes that he made, what set him apart was after he made those mistakes, he would do a post-analysis, he'd come up with rules, and he'd have rules specifically to fix those mistakes. The whole market timing issue came up because he had a year where he had all these great gains, and he round-tripped them because he didn't get out because he didn't recognize that the market was going down. I think post-analysis is really what sets Bill apart in terms of the fact that not only did he identify his mistakes, but he came up with rules to fix them. That was the key. And he followed those rules because of his discipline. A lot of people ask, well, I've been doing this for a while. Do I still have to do a post-analysis? And I'll let you in on a little story. Do you guys know who Lee Freestone is? Lee Freestone, he's been a portfolio manager for Bill since the 80s, one of his most trusted portfolio managers. At the end of the 90s, of course, they had this phenomenal year, phenomenal 2 years, 3 years, and they kept the bulk of their gains. Over a 3-year span, I think they had like a firm average of about 1,400%. And again, they kept those gains during that time, which was the most critical part. And Lee came up to Bill after doing his own personal post-analysis, and he says, you know what, for as great as those years were, I identified all these mistakes that I made, all these things that I really should have done better on. I knew it, and I was breaking rules and stuff like that. So even after a phenomenal year, he did a post-analysis to discover his mistakes. With that, I also want to add a caveat. I don't want you to just focus on your mistakes. Also focus on your successes. You've got to find out what you did right and duplicate those actions as well, not just fix your mistakes. A lot of people find that going through this process is very helpful in terms of discovering your own personal failings. And, you know, sometimes it's a personality thing, sometimes it's just a knowledge thing. Let me just start with the way Bill does a post-analysis. As you kind of saw from the eBay example, Bill sometimes has, like, I don't know, a vendetta against white space. And you might notice that from the paper, too. It's like, gosh, who came up with these charts with all this stuff on it? Well, Bill, because he tries to put everything relevant that he can. If you have some time, and you might need a magnifying glass for some of this stuff, I would highly recommend going through this. And you can kind of see the notes that he writes to himself. This is Brunswick from, what was it, back in the 50s? Yeah, back in the 50s. And he writes notes to himself about how to handle leaders, because this was a leader at the time. He kind of talks about some of the things in the story. The eBay example that David went over, he actually did that. If you notice, the data graph that he wrote that on was from February, I think, of '03. So it was before he made a lot of money on that stock. That was his pre-analysis of eBay. This is kind of his post-analysis, and you see he kind of used some red pen and blue pen to distinguish between the good stuff and the bad stuff. These notes that he wrote to himself in terms of how to handle a leader are very instructive, and of course, some of the technical action that he was looking at. When we get into the simulation, for those of you that haven't done chart school and heard Charles talk about our 2 weeks down, 2 weeks up rule, I'll just let you know where that kind of came into being, because some of you, if you've been with us for a while, you might be thinking, gosh, you know, it seems like that's something that came up in the last decade. Where that came from was Steve Birch and I, when we were working together on the original Level 3 that Steve Birch did with Bill, we were going through Bill's model book stocks. And he had gone through all these model books, and he kept seeing this thing appear over and over in Bill's model books. 2 weeks down, 2 weeks up. And Steve brought it up to Bill and said, you know, this is something I've never heard you talk about. And Bill's like, you know what, I forgot about that. And you know, now it's something that you see in the paper quite frequently, and Charles talks about it as well. And Chris is going to mention that in the simulation. So let's go ahead and get into the nuts and bolts of what we're going to do here. And again, keep in mind, our goal here is to come up with rules that we can use to fix and prevent future mistakes. So break it down into 2 different ways. The stock specific checklist and the portfolio specific checklist is what we're going to be doing here. So with the stock specific, you want to kind of get a sense of how your stock picking is, how you're handling normal fluctuations in your stock. Are you recognizing the leaders? This has to do with the individual stock, applying the CanSlim rules, the buy rules, the sell rules, all of that to the individual stock. So as we talked about in portfolio management, every time a trade is placed, you print out a daily and a weekly chart. It's nice to print out both. And again, if you're using MarketSmith, it's great because you have that historical archive of the fundamental variables as well as the technical action. You can always go back and do a change date on MarketSmith to get the technical action, but if you print it at the time, then you're going to get that snapshot of the fundamental action as well, which can be very valuable. Now, when you get that, mark on the chart. There's two ways you might do this. Again, I love Excel, and I keep a lot of my notes and things like that in Excel as well. So there's a few things that I'll put on the chart. A lot of this information I'll have on the chart and Excel, but I always keep kind of a little note to myself, my primary reason for the trade, kind of what I was thinking, or for some stocks, why I didn't buy it, as I mentioned, like with Coors. And again, this may be a mistake that I do a post-analysis on later. I didn't buy it because I already had INVN, and it was like, okay, I didn't want that kind of overexposure to IPOs, so sometimes I'll do that on stocks that I don't trade. I'll write down a reason why I didn't. The buy-sell date, I mark this on the chart with an arrow, number of shares, price per share, total amount invested, the average cost. Again, this is very important, especially as you're doing your ads. The percent gain loss on the current position. I keep track of this, like before I did my ad, what was I at? And after I did my ad, what was my percent gain? So I can kind of get a sense of where I'm at in relation to the average cost, so that if there is a normal pullback, I know how much can I expect, and the condition of the general market. As I mentioned, sometimes I'll throw up the follow-through day on there, so I can kind of see where am I buying this in relation to the follow-through. Sometimes you can put kind of a sense of where the market is in its overall cycle. Are we early in the cycle, or is it later in the cycle of the market? So all these notes are really helpful for you to just do as you're trading. Okay? It's really simple if you just take a few minutes each day to do this as you're trading, because then it becomes much easier to do your post-analysis. So here's an example with Harman Industries, something you might do. Okay, bought the stock here, had the pyramiding, B1, B2, B3. We can see that we did the pyramiding properly, fewer amounts of shares, so that's right. And then ran into some trouble, sold the first one to try and hold on to it for a little bit longer, but then this happens and we blow the whole thing out. Now, there's nothing wrong with kind of coming back to the same stock. Sometimes coming back to the same stock, you know the personality, and there can be a benefit to that. So we start buying it again. We only get our first two in, and then we're kind of stop right there, which, again, that's something you might look at and say, maybe I made a mistake there. I only bought two. What happened to my third position? Why didn't I do that? The third position comes in here. Well, the average cost, again, if you were to draw a line, the average cost after those first two shares is right there. Okay? So I just kind of put a dotted line. After the third buy, right there, and you can see this might have been a little heavy, given that I only had 3,000 shares. Adding 1,500 might have been a little heavy, but that put my average cost to here, and I knew that going in. Actually, I shouldn't say I knew that going in. I didn't come up with this. This was actually something Steve did. So this wasn't actually my trade. And I don't even know if Steve traded it. He just thought it would be a good example. Anyway, you're going to look at what you did. Is that something that made sense, or was I getting a little too aggressive? After B4, the average cost is here. Notice it's still below the 50-day moving average, kind of buying it out of this tight week. So here's a low-risk, high-probability entry point that we kind of like to be buying, where it kind of makes sense. This is a part where we would add at a point where it makes sense, not just because willy-nilly it's making a new high. And then our fifth buy, you can see how, because of the way that we're adding shares in a small amount compared to our overall shareholdings, it really doesn't ramp up the average cost that much. And at a certain point, you stop. You say, okay, I've got enough of this, the percent of equity that I have, I'm treating this like a leader, I've got a lot of exposure to it. You don't have to keep on adding all the way up. At a certain point, you can stop. But that's how you might do it on a chart. And then on your trading log, the way I do it is I kind of have all the stuff on my trading log, but I'll have the symbol. And that way in Excel, I can filter by any symbol, and then I kind of have the record of everything on there. So again, this is in your books. You can kind of see some of the notes that you might write. You got the date, the shares, the price, all of that. The average cost, again, very important. What your percent gain loss is, and some of the reasons why you were making the purchases that you were making. And of course, the general market condition at the time. This kind of helps when you go back, because you kind of get a sense of what you were thinking at the time. Step 2, organize your trades. Now, this depends on your personal preference. When you do this organization, some people like to do it around tax time. You're filling out the Schedule D. You might as well organize your trades in preparation for that. Some people like to do it at the end of a rally. They figure, okay, now that I'm in cash, I'll do my post-analysis because I'm not trading. I've got some extra time. I'm still watching the market to see what's developing, but this is my time to kind of take a step back, unemotionally look at what I did in this last rally and determine, was it right, or are there things that I need to fix? If you've got a lot of trades, then maybe you can't get to them all, so you're going to divide it with your top percent gainers and your top percent losers. And you might do this in two different ways, as a percent of your equity and also as the overall gain that you got on it. If you see something that was a huge gain for you, but it didn't make much of a difference in your percent of equity, kind of lets you know that maybe you were a little underweighted in it. In level 2, I talk about how I messed eBay up. eBay was my biggest gainer in 2003, and what had happened was I had added to a position, and when I added, it didn't work out. So when I sold that, not only did I sell eBay, the position that I had added, I sold part of my core position. And so what ended up happening was that was my biggest gainer based on that average cost, but it didn't affect my percent of equity very much because I had very few shares. That was a learning lesson that I had from that. So go ahead and do maybe both percent gainers and percent of equity as well. As you study your individual trades, you're going to ask yourself some of these questions. And again, the goal here is to identify things that you can fix and correct to do better. Was a stock a leader in a leading group? Did I have too much exposure to thin or volatile stocks? Did I evaluate the canceling factors? I was talking at the break with a gentleman, and he was saying some of these canceling stocks that I'm looking at that you guys are talking about, they don't have all the canceling factors. They're missing something here, and they're missing something there. Yeah, that happens sometimes. And so now you've got to have a judgment call. If it's missing this, like for example with the return on equity, he was mentioning a particular stock that was below 17% on the return on equity. Bill's going to allow that sometimes if it has strong margins. He'll make an exception for it. Usually there's something that it has to have strong somewhere else to kind of counterbalance that. So take a look at those things to determine, was I looking at those canceling factors? Did I catch these ones that were less than ideal? And was there a reason why I allowed it because it was special in another way? And which factors influenced me the most? Was it the story? Was it the fact that your buddy was in it and you didn't want to miss out? What was the influencing factor for you? Was it because you read an article about it? Was it because you kept seeing it in the paper every day? What was the factor that influenced you the most? Did you evaluate all the technical factors? Which factors were less than ideal? Again, maybe you saw a really bad week in there on very heavy volume. And did it have something to counterbalance that? Did the pattern look a little sloppy? What was going on there? If you're making excuses for things and that's not working out for you, then you know that's something that you've got to fix. You've got to fix the way that you do your analysis on stocks. Did I chase beyond a proper buy point? This was one of the first things that I realized I had to fix, was that I was chasing stocks way too much. I was getting busy. Again, I'm kind of in the same boat that you guys are. A lot of people say, well, I work for a living and I can't just sit there watching the market. A lot of times during my day, Bill's got me doing things that he wants ready after the market closed when he comes in. So he's like, okay, while I'm at home trading and doing my other stuff, I want you to do this stuff, and I have to have it ready for him. So I found myself getting to a point where I'd get so busy on my other stuff that I wouldn't be paying attention to the market. I did the research ahead of time, but I wasn't noticing when they were crossing buy points, and then I'd get frustrated and say, well, I missed it, but I did all that research, I'm going to buy it anyway, and then it would come in, and then it was like, oh, well, now I'm out of position, and the list went on. And I'll be honest, this is where the iPhone has helped quite a bit. If I'm in a meeting, it clicked off this signal and I can put my trade in. I don't know if that was necessarily something I fixed or Apple fixed for me. I'm not sure, but in either case, it's not the problem that it used to be. Did I trade in the direction of the general market? Especially, I have noticed sometimes where I've gotten a little greedy and been like, well, that distribution in the market, that's not going to affect my stocks. And I've been kind of margined and exposed to the hilt when really there were some signs in the market that I should have been noting. And you're going to want to do that. Did you pay attention and respond to distribution days? And also, did you pay attention to the follow-through days? Did you get in when the follow-through days were happening? Did you get in early on? Sometimes I don't get into the right stocks at first, but I can make those adjustments afterwards, but at least I'm in. I find myself paying much more attention when I'm in the market than when I'm out. It doesn't matter what stocks I own, just being in makes me pay attention more. That does help. Also, did I pyramid properly? When you look at your entry points, were you doing the pyramiding properly? Were you using fewer shares? What was your average cost? How was that getting affected by your purchases? What factors were influencing how much I bought, especially when you did an ad? Did it make you overweight in the stock? Did it move your average cost up too much? Were you buying it because of the cushion that you had, or were you buying it because of some other factor, some news item that might have come out, or something that you thought was going to be very important for the stock? And then this is kind of back to that Rubik's Cube analogy that I gave you. Did I have a plan or expectation on how to handle normal volatility? Did I tighten my stomach up getting ready for that punch? Did I know this is the way a normal stock acts, this is the way a leader acts, and if this happens with this stock that is one of my leaders, this is what effect it's going to have on my equity and stuff. And then this is something that some of our portfolio managers do. What's my batting average trading this particular stock? And coming up with your own personal batting average, this is a personal thing. What do you consider a success and what do you consider a failure? Is this going to affect my batting average in a positive way? That depends. If you are just up on the stock, do you consider that a success, or do you have to be up a certain percent on the stock? This helps a lot of people because they find that sometimes they go back to the well too many times, and at a certain point, their batting average turns on a stock. You know what? I'm finding that now I'm striking out on the stock a lot more than I used to. And I may be going back to it for emotional reasons because it worked for me in the past, but now maybe it's done. You have to recognize when that happens. We know what Dave talked about with the economist Schumpeter and creative destruction. Many of these stocks, once they're done, and they don't come back. Recognize that when it happens, and your batting average can be a gauge of that. So really, a lot of this that we're looking at, these are our gauges. These are our instruments telling us how things are going with our trading. Did I have a price objective? Again, in some markets you might use that PE price target based on the PE expansion, or did you at least have some type of sense of where you thought this company could go? Or were you just kind of flying by the seat of your pants? Well, as long as it's going up, I won't worry about it. Or not just the price objective, but also how far down you thought it could come. I want you to be prepared for that too. Have your line in the sand. If it comes down to this level, it's normal. If it comes down to this level, well, now it's kind of in a gray area, and I might have to lighten up a little bit. Any outside sources influence my decisions, tips, news, etc. And again, sometimes Bill has been an influence on me, and not necessarily a positive one in this regard, where I'll hold something a little bit longer because I know Bill bought it and Bill liked it and Bill was telling me the story about it, and then he sold a month ago and I'm still holding on to it. Be careful of any outside source that influences your decision. It could be positive at first, but if you haven't done your own research, it really can be detrimental. Did I catch the sell signals? It's amazing how the sell signals are so much more apparent after the stock has dropped like a rock. Then it's like, oh, there were sell signals all over the place. What happened? Why didn't I recognize them? So, you should be recognizing these sell signals on the way up and quickly after it turns. Now, there's some of those that you might say, okay, I'm waiting for a certain amount of sell signals, or I'm not going to get rid of my position. This is a leader, and I think this might just be a normal correction. And it's fine to make those decisions, but write it down. Say, yeah, I did notice this, but I decided to do this because such and such. And if you find that because of such and such isn't working for you, well, guess what? We've just identified a mistake, right? So if it's working for you and it's keeping you in leaders, that's great. But if it's not, it's something that you've got to change. Did I limit my losses to a maximum of 7 to 8%? Most of us don't have a problem with this, but I've been amazed. Every now and then, something creeps in, and it just got away from me. At the break, I was talking about F5 last year. When I did my post-analysis for 2011, it was my worst performing stock. I had bought it, and I was up. I had a cushion on it. It went into earnings, and I had a little bit of a cushion on it, and I thought, I have enough of a cushion just in case something bad happens. But then that week, there were a couple bad days where it came down really strong on very heavy volume, and it made me a little nervous. And then it just so happened that same week, I was calling up to serve jury duty. So I was calling every morning, and lo and behold, my jury duty service was on the day of earnings for F5. It gets worse. You're sitting in the big room waiting to be called, and hey, there's no problem and stuff like that. And I'm like, you know what? That's right around when lunch is anyway. I'm okay. It just so happened this girl that I grew up with in my neighborhood was serving jury duty at the same time. So she heard my name called, and she ran up and said, Justin, good to see you. So we had lunch together. We were chatting away, and I couldn't get the phone to tell me what was happening with the earnings. And then by the time I saw what happened, we were back in the jury room, and I couldn't get the Wi-Fi to do a trade, and I had no idea what the phone number was. I haven't called a broker in so long to make a trade. I've done it all on computer and stuff. So anyway, it was a disaster. So I had to write a rule for myself. If there's a pretty girl and there's jury duty, still pay attention to the earnings. Just say, hey, we'll have lunch after, the earnings report. What was my loss as a percentage of my equity? We talked about that again, especially if it becomes too big of a drawdown, something that maybe would make you act emotionally because of the percent of your equity. And again, you might have to put a dollar amount. Try that out. Try that dollar amount out and see how that feels. If I lost X amount of dollars, what would that do to my psyche? You shouldn't think of that too much because it can really get in your head. At one point, Charles had kind of his goal of saving up for a certain car. At a certain point, there was a stock that just got away from him, and he's like, oh my gosh, I guess I'm not getting that nice car that I wanted. Sometimes you have that amount, and it's like when I lose that amount, it's like, oh, I just lost this item or something. So yeah, go ahead and make that part of your process. And also, again, the biggest thing here is we're trying to keep the emotions out. We're trying to keep the emotions out of our decision making. And so try and identify any emotional elements that were influencing your trade. That might be impatience, got to make money now. And that happens sometimes, especially if your friends are making money, or maybe you're on a group and you find everyone else is making money and you're not, you feel like you're left out. So that can happen. Shame, again, this is one of those where you're just, I've been taking losses and I'm not going to take another loss. I've got to be right eventually, right? This happens to the gamblers too. They just keep on doubling down on their bet because, hey, eventually my luck's got to turn. And guess what? Sometimes it doesn't. The ego, I know I'm right. Greed, this one could make me rich. Overconfidence. Be careful of this, especially when you're doing very well. You start thinking, well, now the market is going to bend to my will because I am master of the market. Overtrading, this especially when the market is bad, I found to be a problem, where I'm trying to force the market to be better than it is. And so I keep on trying to make a trade and it doesn't work. So I'll try again and it doesn't work. And I'll try again. At a certain point, after you touch the stove so many times, it's hot. Learn your lesson. Usually there's an obvious thing going on with the market where things aren't working. This happened to me again in 2001, where we had these rallies that would be very short and not last very long. And I kept on going in so heavy. All in type thing, and then I get my head handed to me. And so I got out great in 2000. I'm very proud of how I got out in 2000. But I lost so much money in 2001 and 2002 because of these little tiny cuts. I died a death of 1,000 cuts because I just kept on taking an 8% loss here, an 8% loss here, and before I knew it, I'm like, wow, that turned into some real money. So be careful of that overtrading. Revenge. At a certain point in 2001, 2002, that came into play because that's why I started going in heavier, because it was like, okay, I've got to make that money back now that I lost. That's not a good idea. Emotional element there. It just so happened 2001 was also a pressure situation. I had my first child. I probably should have stopped trading once I realized what an emotional thing that was, because now I'm like, I've got to make her college fund this year kind of thing. And this is one that does not fly with Bill at all. If he ever says, hey, why didn't you pick it up at the pivot? And I say, well, because I was doing this project for you. Bah! You have to take responsibility. You've got to find a way to be on top of that stuff. I sometimes still work at that balance, but the way he looks at it is, look, this is your report card. And the market gives you a report card every day. You either got A's or you got B's or you got F's. The report card does not lie. It's very objective. Another thing you can do, take some of these stocks and look at where they are now and kind of determine, did I sell too soon? It's fine, you are going to sell some too soon. We're not expecting you to sell everything at the top, and sometimes you have a good reason for selling. But was there something that you should have recognized? Was there something that should have kept you in the stock? Again, that's something that Bill did with Syntex and Certainty. Certainty was his lesson of a stock that he sold too soon, and he applied the rule that he learned to Syntex, and that's what kind of put him in business. He was able to buy the seat on the stock exchange, start William O'Neill and Company, and I think that's also the same year that he bought his house in Santa Monica, where he still lives. It was because he fixed that mistake that he made. So look at every stock you bought and sold, see where they are now. If there's stocks that you know that you missed, and there was a reason why you didn't buy them, write that down too. See where they are. Did you get in the right names? Because again, a lot of times we're all looking at the same names, we're all looking at the same stocks. Which ones are you passing up on and why? Kind of discover that. This is what Bill considers to be the big fault. He's always going to identify those stocks that he sold and went on to make big moves, because to him that is the cardinal sin. It might not be the same for you, but to him, that's something he really can't stand when that happens to him. Okay, now, oh yeah. Okay, so just to kind of rephrase his question, he's getting back to the pyramid that we talked about. Once you get your first three buys, you got B1, B2, B3, and now you're adding. We're kind of going away from the pyramid in that case, is what you're saying, right? Yeah, that's the first part. Well, not really, because what I told you is when you're doing your ads, you still want them to be fewer shares than your overall base. So now you're kind of considering those first three that established your position. Now that's your foundation, right? And so when you add, let's say you have 10,000 shares, okay? Now when you add, you're not going to add 10,000 shares, you're going to add a smaller amount on that foundation. So it could be 1, 2, 3,000. We had that example in the book where depending on how much you're up, you're going to be adding, but it's still going to be a smaller amount, and that's going to raise your average cost only a little bit, not a huge amount. And here's where we have to be realistic, okay? So getting to your point, okay, this is what I was saying about at a certain point, you're going to have to stop adding. It's going to be a certain percentage, and yes, maybe you could make more money by continuing to add. If you have a great amount of discipline and you are really very experienced, then yeah, you can keep on adding. But for most of us, we've got our limitation. And I want you to come up with your limitation ahead of time, because what happens is if it goes through a normal correction, if you've got 100% of your money in a single stock and it goes through a normal 20% correction, that's going to probably make you lose your nerve. Now, of course, you can pare back on that, but our goal is to be realistic too. When you say knock it out of the park, yeah, that's what we want. To be honest, where Bill's wealth has come from, it's usually a few stocks each year, his big winners. That's where the big gains for him. Not to say that those 20% gains, I mean, those add up and compound to some real money too. But yeah, those big winners are what we're looking for, where you do knock it out of the park. But you also have to be realistic as to how much a percent you can have in that and still handle it right. Because the more you have in it, the more emotional it will be. And if it starts making you more emotional, imagine you're driving, and if you're having a heated conversation with someone, you're going to be distracted, right? Your driving is going to be affected. Or if you're texting at the same time that you're driving or talking on the phone, these are things that can distract you driving. In the same way, having an overweighted position, more than you can handle, and again, this is different for everybody. Having more than you can handle is going to be a distraction and is going to make you make mistakes. So I'd rather you kind of get to know yourself and know what you can handle. And if you can handle a greater percentage of equity in a stock, that's good. What you're going to do is you're going to build your position. You're always going to do fewer shares because you want that average cost not to raise too much. But yeah, if it comes out of a second stage base and you want to add to it, absolutely. But know where your limit is. And if you don't have one, Bill, I don't know if Bill has a limit. Because again, I've seen him heavily invested in one stock and he's on margin. But he's also Bill. I wouldn't recommend that for everybody. And I also know, and he knows, that he's very disciplined and he'll react accordingly. He's asking, in a trading log, it does have percentages and dollar values. Is it better to focus on the percentages? I think so. I think sometimes the dollar amount can mess with my head a little bit, and the percentages keeps me a little bit more grounded. There are certain cases where I might look at it, because again, when I pull out my mobile, it does show dollar amounts. So I kind of want to know, is that something that maybe skewed my decision making? But when I'm actually trading, you know, a lot of times I'll hide that column. And again, that's why I like Excel. I can make it however I want, keep track of the information, make it what I want it to be. Now our goal is we're looking for patterns and we're trying to write rules. Okay. Oh, yeah, one more.
If a normal position to you is like $100,000,
right.
and you're 6 stocks or 8 stocks.
So he's asking what's reasonable. In your example, what he came up with was $100,000. If you've got 8 stocks, once you get your full position, that's going to be 12.5%, right? So how much adding before you stop? That's again what we talked about in portfolio management. Go to that chart. What kind of drawdown do you think you can take? For me right now, between 35 and 40% of my equity is what I feel comfortable with. It doesn't bother me. I don't find my emotions getting out of control with that. Now, of course, I might find my emotions getting out of control if I have a huge drawdown. But at this point, I think I can handle that. And so if I'm starting at a 12.5, 15% as my starting equity and I make adds, and also keep in mind, it's not just your adds, it's the appreciation that happens too that's going to make that. So don't just think it's your adds, it's the appreciation. So again, sometimes your big stock, it can get over the amount that you want fairly quickly because of that. And I wouldn't necessarily say that you have to pare it back just because of that, but you have to be aware, okay, maybe I'm not going to add any into this stock because I don't want to get overly weighted and put my emotions into it. It is a little bit of a balancing act. And again, this is where I can't give you a specific rule for you. That's part of what the post-analysis does. It allows you to make your own rules. I'm not saying you're going to make rules that violate the tenets of Can Slim. If you come up with a post-analysis that says, you know what, I'm noticing that a lot of times I sell at 8% and the stock goes back up, that's not the time to change the 8% rule. Okay? I want to make sure that's very clear. Those rules are kind of, you can't touch those type things. The rules I'm talking about are kind of your personal, how much you're invested, identifying your own mistakes of things that you might do that aren't quite in line with what you should do and recognizing that. So again, what you're going to be doing is you're going to be identifying these patterns and coming up with your own personal rules. So And again, this is what made Bill successful. He came up with these specific rules for himself that he started to follow. And again, you've got to have some reason for coming up with the rule. Looking at, for instance, when he came up with that certainty example that he messed up, he didn't just say, well, gosh, uncertainty, if I had held that for 8 weeks, and if I just apply that from here on out, that's going to be great. No, he looked at a lot of stocks. He looked at a lot of leaders and saw the way that they acted and came up with that rule. So he did some research. The goal here is to look for these repeated mistakes. A lot of times you're going to find that there's just a certain thing that maybe you do over and over that keeps on compounding your losses. When you start organizing your trades, you might find that there's a similar mistake that is happening on your losers. And if you can fix that mistake, well, that's going to help you out a lot. Or Bill's going to look at those missed opportunities as well. He's going to kind of consider that a loser. I had a loss of opportunity here, and if there's something that you're not recognizing, or, I got busy, and believe me, that's happened to me too. 2004, we kind of created the seminar series, and that was a very busy year for me. It was probably one of my most frustrating in terms of how well I did in the market versus how well I should have done, because I kept on working on the seminar stuff and kept on neglecting. I was just late to everything because I just wasn't paying attention. It's those types of mistakes that you got to fix. And again, if you see a pattern here, when you do this organization of your trades, you're looking for these patterns, reviewing these. Also kind of start, if I had applied this rule to this portfolio, to this rally, what kind of difference would I have gotten? If you find that you had a lot of mistakes where you let something go beyond 7%, if you fix that, how would that have improved your results? Kind of get a sense of that, because it can kind of help. One of the other things here that you're doing is you're kind of getting more confidence in yourself as well, building your confidence that you've got an understanding of what you're doing wrong and that you know how to handle it in the future. Because believe me, a lot of the mistakes that you make, they're going to happen again. Those same things are going to present themselves. And you've got a choice. Are you going to let the same mistake keep on hindering you in your performance, or are you going to fix it and figure out what to do in the future? Now, this final point down here, don't complicate the process by having too many rules. Bill, he still has his portfolio managers do their own post-analysis. He can be hard on the guys sometimes, and there was a particular year where he said, you guys could have done much better. I mean, they still had a great year. It's not like they had lost their shirt or anything. It's just, yeah, you could have done better here. So I want everyone to come up with their list of rules, your personal list of rules. You had a due date on it and everything. And people did varying levels of depth. Usually, with each post-analysis, you're going to just find a couple things, and those are the ones that you want to kind of really keep track of. Part of the issue is, some of these things, they're not going to come up next rally. They're not going to come up the rally after that. But maybe 4 years down the road, you're going to see a similar situation. And if you've done this analysis, you'll know how to handle it better. You'll say, oh, I remember that stock, and I remember how I messed that one up. Believe me, like the eBay, that sticks in my head. And if I'm ever on jury duty again, F5 is going to stick in my head. There are certain things that are going to stick in your head. Okay. Let's get to the portfolio specific. So we got our stock specific, but we also want to do some portfolio specific analysis to see if there were things that were out of whack in our portfolio that maybe made us make some poor decisions. So in addition to everything that you had on your trading log before, you might put on your total equity, the stock's percent of your equity, your percent invested. How heavily invested were you? Were you 100% invested? Were you on margin? Were you heavily on margin, 120% or 175%? So these are some additional things that you can put on there that will kind of help get you in that emotional frame of mind, because a lot of this portfolio stuff can be very emotional. And also the number of stocks in your portfolio. Because sometimes you can have a lot of stocks in your portfolio, and it's that nature of confusion. There's so many stocks you have. There's that concept, when you have too many stocks, it's not necessarily reducing your risk, because what happens to a lot of people is, number one, they either feel like they're safe because I've got so many stocks, or number two, they freeze because they're looking at a sea of red, and now I don't know which stock to sell first because I've got 50. Which one do I sell first? So be looking at that. And then I talked about batting average earlier with a particular stock that you keep on going back to, but maybe look at your batting average overall. How many trades are you doing successfully? How many trades are kind of not working out for you? When you see your batting average start to go bad, that's letting you know, okay, maybe I'm not on like I should be, or maybe I'm out of whack. The thing about your batting average that you have to recognize is kind of what they call in game theory and statistics the string of losses. If you've got a bad batting average and you keep on having losses, well, yeah, you might cut those losses small at 8%, but if you've got a bad batting average, eventually that string of losses can ruin you. You got to keep your eye on that batting average, and maybe you have to back away a little bit. Maybe you have to say, I'm not going to get as heavily invested until I improve my batting average. Now, that's something that I've done in the past. because I just was not on. And I've seen this happen to all of the portfolio managers. Bill treats them like stocks. In terms of how much money he gives each of them, you can tell which manager is doing well because he'll give that manager more money to work with. He treats them like stocks. The manager that's winning gets more money. The one that's losing gets money taken away. So anyway, do that batting average to kind of get a sense of where you're at. What was your cumulative gain or loss for the year? Or if you're doing from the rally, whatever is working for you. And of course, what stage of the market are you in? Be aware of that. Where are you at in the cycle? Because sometimes you can get overly aggressive when you should be getting less aggressive because of how far the market's come. Also ask yourself these additional questions in addition to the stock specific. Did I have the leaders in my portfolio? One of the ways to determine, is this the Cisco that's going to go up a zillion percent, is kind of what David talked about with the investing with conviction. Did I have the leaders in my portfolio? Was it the real leader in the group? Was this one of the real leaders of the whole market? Is this going to be one of those that they talk about as, oh yeah, in 2004, Apple was the one that came out, and Google? Is it going to be one of those? What percent of my portfolio ended up in leading groups? And how is your weighting as a percent of your equity? How many positions did you have when you placed the trade? How fully in were you? Were you too concentrated, too diversified, too many stocks? Look at all of those things because, again, you've got the gauges now. If you have this information at your fingertips, you've got the gauges and you can kind of determine what gauges do I need to, for next time, move in a different direction to get better results. And also, what percent of my equity was in the same industry, sector, or other, I would say. There was a time in which I felt like I was too invested in China stocks. They weren't in the same industry. One was a telecom, one was a medical, one was this, but I was too heavily in China. It was more than I should have been. And I was thinking back to the Shanghai surprise, type thing. If something like that happened, I could be overly exposed because I'm not diversified enough out of China. Or, as I said, if there's too many thin stocks, that could be another thing, or too many newer names that don't have history. Are my position sizes increasing, decreasing with changes to my equity? Having those predefined rules on the number of stocks that you own will kind of help you with that. And also making sure that you're adding properly. And then also, were you using margin? How heavily were you invested? And if the trade was a loser, what percent of your equity was lost? That can kind of tell you if maybe you were too heavily invested in a single stock there. Now, this is something that I do for myself. Again, I love Excel. So sometimes what I'll do is I'll plot my own equity curve. Okay? A lot of times what I'll do is I'll index it. A couple caveats here. For those of you that you have an account and you have cash flows into and out of, I know most of you know this, but make sure you take into consideration those cash flows and that you're doing a time-weighted rate of return. Do you guys remember the whole Beardstown ladies scandal? Lovely old ladies that were getting together with their investment club had these phenomenal results. Well, it turned out that they weren't taking into consideration that they had dues every month, $25, that they kept putting into their account, and they didn't factor that in. So it's like, well, your results weren't quite as big as you thought they were. This kind of shows you, sometimes looking at this is INVN right there. That's what it did to my account when it had its first pullback, and this is what happened when it did its second pullback. But now I'm back to beating the market. By looking at this, I can visually kind of see areas where I might need to focus in on and say, okay, what was going on here? I know I was a little slow to start because, again, I wasn't getting too heavily invested that quickly, but then that INVN was really kind of making a difference in my portfolio. And I didn't update this. It's actually up now more because of Friday. So I think it's right there. I'm 2% off my high. This was February 23rd. I'm about 2% off my high. And then maybe keep a running tally of some of the lessons that you've learned through this post-analysis. And hopefully you guys do go through this process. It's one of those things where, yeah, it's not the sexiest thing to do. It's not the funnest thing to do necessarily. But it can have huge gains to your portfolio if you do learn to fix these mistakes. So this is kind of a list of some of the things that I've learned. I started trading in 1997. This was actually my first stock. I inherited Ford stock from my grandmother after she passed away, and that was my first stock. And one of the first things I did was sold it because it was a big cap. And I didn't recognize that it was coming out of a cup with handle. So that was one of my first lessons, down to getting distracted during earnings, F5. Bill still does a post-analysis. All the portfolio managers still do a post-analysis. So it's a very valuable process. If you put in the time, it's something that can give you huge returns. So any questions on that? Is there a real simple way to find out the leading stocks right now? One of the things I do is I look at the leaderboard, the names that keep on popping up in the paper, the sector leaders, that's another place I look. It's those names that keep on popping up place after place after place that kind of lets me know this is where the leadership is. And I make sure that I try and have some of those names in my portfolio. And if I don't, then I've got to ask myself in my post-analysis, why did I miss them? Between the sector leaders, the IBD 50, and the leaderboard, pretty much everything I'm in is in one of those things right now. There was another question back there.
So your post-analysis, that's just on the portfolio?
The post-analysis is on both the specific stock and the portfolio. So you want to do both. So that's why I broke it into two parts. There's the stock specific. Okay, yeah, that's what you're going to do. How was my stock picking? Was I recognizing the signals in this particular stock? Was I recognizing, was it a leader? That kind of stuff. And then there was also what was going on in my portfolio. Because sometimes you're making a decision based on your portfolio. So I didn't add to this stock because of what was going on in my portfolio. Was that a proper decision or not? And some of those things, it's real easy to look back and say, oh, I should have added here, I should have added here, but there's other things going on. Maybe the market was under distribution, and so that wouldn't have been a good add at that time. It would have been a little bit riskier. But if the market was coming out of it, did you take the opportunity to add at that point?